Welcome to the Broken Pie Chart Podcast, episode 222. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, although you've been more permanent than semi-permanent of late. It's Jay Pestrichelli, CEO of ZEGA Financial. Jay, what's going on today?
Derek, it's an exciting day in the market. It's right before a 3-day weekend. When people hear it, maybe it's right after, but things are moving and shaking, man. A lot of interesting stuff to talk about.
Yeah, let's get into it. We got to touch on Nvidia and just the gain in market cap. We'll talk about that. 7% on Treasury Bills. But first, I saw a great meme, and obviously our audience can't see this, but I'll describe it. And it was basically AI is throwing a party on like a yacht, and then you have crypto. Somebody is, treading water, about to go underwater. And then blockchain is a skeleton at the bottom of the ocean, like sitting in a chair, just sitting there. Like,
yeah. Look, those had their chance to be market movers, and they were in a very narrow, slice of companies, right? And you're right. Like I think we talked about this last week, right, where we thought, crypto would be the thing that defines this, the Gen Z and the hot thing in the market. It looks like it's AI right now. I mean, is there anything hotter besides political strife? Is there anything hotter than AI right now? I don't think so.
I would also say that now, that I've been a crypto skeptic. I've been a blockchain skeptic because I look at it and I say, is there anything that I can use today that's crypto or blockchain outside of crypto? And my answer is no. I think that I think it's disappointed. But AI, like people are legitimately using that for stuff. Although, we always tie things back to the market. And this is not unlike what I saw in 1994, where every telephonist, call it telephonist to Chile, telephonist to Mexico, all were trading, going nuts. That was the thing. And, we've seen this sort of song before, right?
Yeah. Well, yeah. I mean, look, I don't know if you were going with the, hey, I didn't believe in crypto and it's not the thing, but I believe in AI and now it is the thing. Is that where you're going? You're gonna take some.
Oh yeah. Yeah. I can take a victory lap. Yeah. Crypto is.
But I'm not. I'm
Yeah.
not willing to throw crypto out with the bathwater. I'm just saying it's not the thing leading the market, right? It's not the thing that's pushing, dramatic appreciation. It's not the .com boom. It's not when Clorox, put a .com at the end of their, ticker, their name, and all of a sudden, they went up 30%, right? It's not. Yeah, I gotcha. But it's fine. It's actually, you could argue it's been more stable than treasuries. Can we make that argument? I don't have the numbers in front of me.
What did you say? AI is more stable or crypto?
No, I'm sorry. I'm saying crypto is more stable than treasuries right now. I might be exaggerating without any math. It just feels pretty steady, and treasuries are all over the place.
Well, if I didn't already put in a prompt into my AI thing already, I would look that up and see if it would tell me. But yeah, I don't know. My point is, like kids in their dorm rooms are using AI right now. Nobody's using blockchain besides the people doing blockchain stuff. And I don't even know what that is. I'm a skeptic. All right. I'm sticking to it. I do think AI is the thing.
I mean, yeah. I mean, look, AI's got some real meat behind it. Agreed. It feels a little overblown, but we'll see, right?
Well, let's talk about overblown. Nvidia, what do they say on their sales? They said something on the call. Oh yeah, we think we're gonna. I don't know if it's double sales, but
They think they said double.
Did they really?
They said double.
That's kind of promising.
I think they said double.
I mean, granted, the stock probably trades at a really high PE multiple. I haven't looked it up, but just to put in perspective, Jay, Nvidia gained the other day. I think it was anywhere from 175 billion to 200 billion in market cap. And to quantify this, if you just took at the look at the dollars gained in market cap, so market cap is the number of shares times the price of the stock. So just the gain in market cap would have been equal to about the 35th biggest company in the S&P 500 index, Jay. This is big, and I'll throw I'll throw one more thing out.
I was just saying, I believe. Yeah, go ahead. You go.
Yeah, and then I went and I asked. I did some AI research, as you know, I love to do these days. And I went and I said, Tell me, what other companies have ever gained as much in market cap? I haven't checked this at all, but Amazon in 2002, 191 billion, Apple in 179 billion. Of course, those companies were 1.7 trillion and 2.9 trillion, respectively. In they already had a big market cap, so that's a big move, Jay.
It's a big move. Yeah, there's no doubt about it. It's been a while since we've seen something like that, and the story behind it is pulling everything else up around it, right? If you throw AI in any of your, I feel we're going to see more and more press conferences and companies talking about their component of the component of their company that has AI. It just feels like you can't ignore it at this point, right? So it was a big move. Like, we've been trading for years, and it was a big one. Let's put it in that context. It was a big one.
I mean, what was its attribute? So the S&P, the day that it gap opened up, what was it, 30% or whatever it was, the S&P gained what, 1%, I think, probably close to that.
I think at the open it was around 1%. There's a lot of stuff moving around there, right? But
Yeah,
yes,
but I mean, you think about, I mean, Nvidia is a pretty big company now. It's in the top 10 in size. So
it's 30% bigger now than it was last
it,
week.
no, that's right. So my thing is, I mean, that most of the gains that day you probably could be attributed to Nvidia. I mean, you saw that, like, Nvidia is not in the Dow, and the Dow is down, and the S&P was up. So
Yeah, no, perfect. Same thing with the rut, right? The Russell, I think, was flatter down the same day, right? So yeah, it's pulling the whole market up with it, and I think that'll start to bleed into other tickers. I think Marvell came out the day after, right, which was today or last night, and they also mentioned AI. That's up. I mean, it's not up 30%. Don't get me wrong, but it's going to be that kind of a feel to it for a little while. I don't know the model yet for AI, like the revenue component, right? You're paying what, a subscription for a certain amount of services or certain amount of access, right? So is it going to be a service revenue model? I've looked for Nvidia and Marvell. I get it that they are producing the components that allow AI to run, like obviously the chips, but like who's paying up for all this, right? Like eventually there's somebody paying for AI, right? Somebody wants that capacity, and how are they selling it, right? So I don't subscribe to ChatGPT. I know you do. How are you paying for it? What are they making off you?
well, they make $20 a month, but I get ChatGPT 4, so that's the highest or the most recent. You can get ChatGPT 3.5 for free. And you're right, but I mean, it's open sourced. I guess I have they call it quote unquote picks and shovels. It's Levi's made money, is still around during the gold rush when everything else went bust because they sold blue jeans. So, and I'm not saying you should go out and buy, like, if you don't own Nvidia. By the way, if you own the S&P 500, congratulations, you already have Nvidia in there. That's part of the value of buying and hedging, but buying large cap indexes, you have it. But yeah, Jay, I mean, I think this is, I mean, look at what happened in late 90s, early 2000s. You had a lot of players that came into existence. A lot of companies went bankrupt, but the technology kept going forward. I don't know what the direct business model of, a chat GPT is yet. I think but it's the existing companies that might be able to use this. But I mean, could you imagine if it was closed source? But maybe if it was closed source, it wouldn't be used. It wouldn't be adopted like this. I don't know. This is what I'm saying. I mean, it's like, this is 2 months old, Jay. Like, really, it's 2 months old.
All right. Well, looks like Nvidia is going to be an early benefactor of it. Let's put it
Well,
that way.
so far, Intel. What is it? Somebody made the quote, or I read something online that Intel has. I haven't even looked it up, so I'd be making it up. But like, Intel's revenues are higher than Nvidia's, but Intel is down versus Nvidia. I don't know. Um, I'm not telling you to buy or sell Nvidia. I don't know where the stock's going. I'll let you know in a year what it did in the next year. How's that? But I will tell you, Jay, what is going up as well is yields on treasuries, not only across the board, but also we saw a 7% annualized yield to maturity, Jay, on a treasury. That's exciting news, don't you think?
Yes, nice transition, by the way. Yes. So on the flip side of things, and it's strange, right? So the dynamic has definitely changed a little bit here. I think there's a couple things pushing it around, right? Clearly, the debt ceiling discussion has been a factor on the short end of the curve. The yield you're talking about, Derek, was a pretty short-term treasury, correct? What was the duration on it?
Yes. So I looked at this on May 24th. It was the June 1st expiration. So essentially, it's a week, and your annualized yield is 7%. So, Jay, I'm going to put on my professor hat for 10 seconds. I'm going to explain this.
Yes,
Okay,
please.
grab your pencils, everyone.
You need
Listen
a
up.
sound effect.
Well,
Derek, when you go to professor, you need
I'm
a sound
working.
effect.
I have the ability to do it. I didn't. Here, hang on. Let me do. How about this? That's
That's great. I
the
love
only.
it. I love the
That's the
sound.
only one I had queued up there. It comes with the program we use. Zencaster, great podcasting recording program. All right, here we go, kids. Listen up. Grab your pencils. When you buy a treasury, you buy it, and T bills. This one in particular that I was looking at, it doesn't pay a coupon. So you buy it at a certain price. At maturity, it matures at $100 or $1,000 per bond. So you could have bought this one for roughly, when I looked at it, it was below 7%. But let's say you buy it at $998.70. It means you buy it at that, it matures a week later, and you get $1,000. So you make $1.30. That yield to maturity assumes that you're doing that, and you're going to get it again and again and again, like 52 more times. So even though you're only getting $1.30 annualized over the year, that's how you get right around that 7%. The reason why these yields went so high is because the price went down, and people, although even if the Treasury were to default, it's you own a Treasury. And so my belief, this is my opinion only, you would not get your money back. But let's say it took you a week or there was a little bit of delay. That's an opportunity cost. And so nobody really wanted these bonds. So that's the end of the chart school, Jay, the school session. But that's what you're saying.
So it's not like you made 7%. You didn't make 7%. You wouldn't make 7% in a week. It's an annualized rate. And it's just probably because there's a little like, what if it takes an extra day or two for you to get your cash? And so they probably say, normally 5, move it to 7. Maybe it takes 2 days for you to get your money. There's almost a way to infer on how long it takes to approve the debt ceiling in that. But now maybe I'm reading too detailed into it. Yeah.
No, I think you do. But yeah, and to your point, Jay, I mean, I think the actual yield is like 0.13%, which interestingly enough, in 1 week on that treasury bill, you would earn as much as you would have in a year on a 2-year treasury bill back in, pick any year like 2017, whatever. When 2-year treasuries were generating basically 0.13, 0.15% annually. So the tides have changed on yield, Jay, for sure. But even if we go out the next, I'm looking at, and I know I sent you a document. You'll have to page down a little bit, but I pasted in the U.S. Treasuries. The 1 month is getting close to 5.6, 3 month 5.32. Then you go out, 4s and 6 are actually higher, almost 5.5. So Jay, yields are ticking up, and it's interesting to me because one of the things that we're seeing is a lot of duration hunting. Eric Baltunas from Bloomberg, you were on with him, I remember, right, Jay? Were you on in studio, or
I was
did
on
you
with
do?
Eric. We did remote with Eric.
You
Yep.
did a remote, yeah. So he's good. He covers their, he's sort of their ETF guy, or one of the ETF guys. He puts out a lot of good content on that. And on Twitter, he put something out. It was a screenshot showing TLT, which is basically the 20 plus duration Treasury ETF, I think it has the most year to date fund flows. And at the same time, too, maybe we'll talk about this secondarily, the 3X daily, basically TLT ETF, is also seeing a ton of flows. Like, what is everyone doing here? Like everyone's going for long duration. Like the market is betting that rates are dropping, right? But we're not seeing
I
that.
mean, that's it. Yeah, I mean that's it, right? The reason you'd add that duration is if rates were to drop, your bonds would appreciate, right? We know that they have that kind of seesaw inverse relationship. So the theory is the long well, not the theory, the math works out that the longer in duration you have, the more you'd appreciate if rates were to drop, right? So it's a little bit like you move the lever a little bit, you move the fulcrum of that seesaw, and so what happens is, I think, right, this is a position where people are, probably feel that rates will be lower in the future. So I want appreciation in my bonds. Unfortunately, that has not been the case, right? There was what data came out this morning, Derek? Was it PCE? Was
No,
that
that's
came
right.
out this
PCE.
morning?
Yeah, that was a little hot, right?
And it was hot, and looks like maybe rates aren't going to go down anytime soon, and we've seen a transition in the market from a projection of maybe rate cuts to maybe not so many rate cuts by the end of this year. So, and we could dig more into that in a minute, but I think your point about why do we see inflows into like the longer duration products, it's a price appreciation play, right? There's no other way to describe that, right? So it's a bet that rates will drop in the future, and right now, unfortunately, you're on the wrong side of that bet because rates have been going the other way. Rates have been ticking higher over the last few weeks, especially out farther on the curve. When you look at the price change of say TLT, I think I saw today it was at 100. Sorry, I'm going to do a little cheating here. Yeah, right. So I think it touched on $100 dollars a share. But if you were just to look as recently as, I don't know, let's say the beginning of April, it was more like 108. So that is, obviously that's $8 down on 108, almost about 8%, 7% drop. The point is that as rates have been going up, those longer duration products have been hurt, even though there's these inflows, right? Even though there are a lot of inflows going in. But, interesting if you look at charts, Derek, that's maybe a level of support here, but yet to be determined. Hard to know.
You mentioned the key phrase too, and I'm going to do some math on the fly here. You can hear me clicking in the background. And the duration of a 30-year treasury, and let's make the coupon 4%. Let's say we have a brand new fresh off the rack, and we're going to say that rates are at 4%. If I do that, okay. So it's roughly 17 years plus in duration. So if interest rates went up 1%, you would expect to lose roughly, back of the napkin about 17%. And the inverse is true too. If rates drop by 1%, you make roughly the same. When I say back of the napkin, duration sort of changes a little bit and you have convexity. We'll leave that aside. But Jay, I think that's what you were saying. People think rates are going down. They're not buying that because they're excited about getting 4% a year for the next 30 years, right?
Nope, nope. It's a value of the bond play. That's right.
So then Eric Baltunis also on Twitter, and I thought this was interesting as well. He posted TMF, which I guess is the triple leveraged, so basically 3x TLT. And the fund flow, there's been a lot of fund flows over the last, let's say, March, April, May. And this is down about 9% year to date. Now, Jay, I guess we should give a little public service announcement. Like these triple products are not meant to necessarily over the long term equal TLT, right?
No, no, no. Right. You don't, I mean, generally speaking, you don't want to be in triples for longer than, a week, right? Because you get the compounding of the math works against you quite a bit. And even if you're right on direction, you could still lose, right? So buying a triple and being like, great, I'll make triple and come back in a year and you'd be wondering why you didn't make money and you lost money. You have to understand the math movement there, and the daily repricing and compound challenges. I bet the professor could do a whole class on that one, but just service announcement: don't hold anything that's leveraged up or down, leveraged too long.
Yeah, and Direction, by the way, this is their product. I believe it's theirs. They actually have videos on their site, and they're pretty clear about what it is. I mean, they're trying to do a daily price change. What's interesting too is, unlike a risk parity where you say, okay, well, 30-year treasuries are yielding 4%. So if I do a risk parity and I do, return stacking, or I do leverage on top of this and try and get, two times can I get 8%? These are different. I mean, the dividend, and this is according to NASDAQ.com, and obviously TLT, dividend is going to change if rates stay higher and blah, blah, blah. But the dividend yield they're showing is about 3.21%. On TMF, it's only 1.88%. Do you think people are going into this, Jay, and thinking they're going to get triple the dividend too? I hope not.
No, it's just adding the daily volatility. By the way, these are great trading vehicles. Don't get me wrong, right? You want to day trade these things if that's what you want to do. A lot of people find that fun. Great. These are fine for that, right? If you have a thesis, it helps you. And like, there's a benefit here on these things where you don't have to like trade in the futures market and use the leverage there, right? So they definitely provide some good. We're not saying they're toxic. We're just saying don't hold them too long. And you certainly shouldn't expect the dividends to increase. It's all has to do with the bank swaps and how they create the leverage. And there's a lot of players taking a piece out of those products, and so it should not be for the yield, right? You want to do yield, you should be talking about the options market as a way to generate yield instead. But that's a different conversation. Yes, it's trade them. You're going to get triple, double the move. Don't hold them long.
All right, Jay, you tease the changes in expectations for interest rates by the Fed. So let's kind of go there. I want to start with just, I'm going to go on. It's not a rant, but everyone goes on television. All right, I'm just going to do it. It's Friday.
You
Like everyone
rant,
goes on,
do it. This is
yeah,
what the time
everyone goes
for.
on TV and says, "Oh, the Fed funds are pricing in a quarter point raise now." And 2 weeks ago, they're pricing in no change, and they're pricing in a quarter point cut. And like 2 months ago, it was like this or that. All right, let me explain something to you. The market implied terminal rate, meaning that the highest that the Fed funds is going to get right now, is basically saying 5.26%, which would be another quarter point. And if people out there are saying that's the most rates will go up to, I just want to point back to June. We're coming up on June. And the beginning of June, rates were, the implied terminal rate was 3.25%, meaning that's the highest that rates will go. So, like, stop looking at these things and thinking this is the gospel. Like, this is exactly what's going to do, things are going to do. And by the way, can I just say it? Like, stop looking at the dot plots when it's a dot plot meeting, because I can show you 5 years ago what they thought the rate would be today, and it's not there, Jay. But regardless of that, I don't know if you have any comments on that, or you can just talk about what you're seeing in the rates market.
Well, I don't want to get in the way of your passionate discussion here, but I will say that look, you're right. The narrative changes every day, and we are definitely seeing a change in the narrative. Right? It was a no-brainer just 4 months ago that we were going to have a recession. The Fed was going to have to cut. They're being too aggressive, despite the Fed saying they're going to be. You should expect higher for longer, but now here at the end of May, the narrative is definitely changing. Believe it or not, Derek, the odds of a rate change for the June meeting went from basically nothing a month or two ago to now there's like a 65% chance that we will get a rate increase at this meeting, right? Everybody thought we were done. People were talking about the Fed cutting. You're right. It changes from day to day. The narrative can definitely change. And it's just something that you have to be aware of, and nobody knows the future. I know we talk about it all the time, and we remind people we don't know how it's going to turn out, but we're happy to observe what has happened already, and there is definitely a change a coming when it comes to the outlook, And the rate meeting in 2.5 weeks is going to be interesting.
Put some color on this further. 1 month ago, so this is April 26th, which, yeah, it's sort of today is May 26th as we're recording this. The probability of a quarter point raise was 13.7%. And as you pointed out, Jay, it's getting close to 65% today. So was the market wrong a month ago? Or was the market right? Is the market right or wrong right now? And I believe that these closer into the meeting that you get, and the Fed has not really done any surprises. They've pretty much whatever's been telegraphed is what they've done. Like they haven't gone like the market, the futures 2 days before the meeting weren't at a cut of 50 basis points and then they go ahead and raise. Like they pretty much done what the expectations are nearest to the meeting. But yeah, and I would say these we're seeing rates across the board go higher. We're seeing it, as you pointed out, not only in 30 years out, but we're seeing it in 5.6% you can get 5.5% for like 6 months now or something like that. So
Look, there's a lot of people that are happy to have that rate.
it's
It's fine.
fantastic. It's great.
Yeah, it's fine. It's
Well,
fine.
I've always said, and we brought it up before, people assume the rates have to get cut back to, oh, they got to go to 2%. They got to bring Fed funds. Why would they do anything if there's no recession, if there's no reason? Like this is what they always wanted to do to get out of the endless, chasing your tail of we got to be at zero rates, we can never raise. Like, isn't this what they wanted? And if you get no recession and retirees and can get 5.5%, 6%, whatever it is in treasuries, which the quote unquote have no risk, like that's a good deal for people, I think, Jay. And so I don't know. I mean, this higher for longer now is certainly taking hold. But I go back to why would they lower? They're not going to just lower because they feel like it. Like why would they lower, Jay, without a recession, without pain?
Well, I mean, I think the goal for the Fed is typically inflation plus one, right? Is where they like rates to be for, whatever their math is, right? That they like that. And so if inflation does come down to 2%, having a 5% rate is higher than why for all the reasons that they like that in their equations. I'll also add that it's more expensive for the US to pay that debt, right? So there are some reasons and arguments as to why, if there's no recession, why they might want rates to bleed down. When you take a look at what they project on a 5-year basis, they see Fed funds at 3.5 because that's kind of where they'd like it to be when inflation is 2 to 3%. Like there you go. But it doesn't mean they have to act. They can take their time.
By the way, you mentioned the political considerations. That is a factor. And the way, could we see at some point Joe Biden grabs two of his big Secret Service agents and walks over to Jay Powell's office, closes the door, says, "We're having a conversation on rates." And I say that sarcastically completely, but there have been books written about, I think it was Lyndon Johnson got into it a little bit with his Fed chair. I think Nixon may have as well. People can Google that or use ChatGPT to do that research. So your point is a really good one, Jay, in that right now the annualized run rate is just under $1 trillion annual that we're going to have to pay on our debt, our interest payments. So we borrow money, we issue treasuries. I say we, like I'm not the one who ran up 25 trillion in debt, but they did it, and that becomes untenable. Imagine if we get to the point where 2 trillion is the interest cost per year. So I agree, Jay. I think it's a smart thing to bring up because politically, there's going to be a lot of pressure on the Fed to lower rates, don't you think?
Yeah, yeah. And look, you just gave me, you asked why would they lower it? There's one reason. I was just answering your question.
All right. Well, I went a different direction. Jay, the I asked the question, by the way, in our investment committee. We sort of have these discussions that aren't really tangential or meaningful to anything that we're doing. I mean, we buy and hedge, we buy and buffer, we have other strategies, systematic selling volatility, but we have these great discussions. And I think one of the things I threw out is, do you see Fed funds or treasuries going to 6% before core CPI gets below 4 on an annualized basis. And I think you kind of have to think about it, right? I mean, rents are still going up.
So talk through that. So that dynamic historically has been what? Like, why is the relationship like you're projecting something that would be I think you're picking two interesting points here. So what has been the relationship between them in the past?
Well, I mean, so rents in particular are, I think, and housing is like 40% what makes up, some of the core CPI. I could be wrong on the shading of it. And I pull up, one of the things I watch is the Zillow has these observed rents, and they update it at the end of every month. They put it out, and that is less lagging than the Fed's CPI data. And although they came down maybe November, December, they've been moving higher every month since the start of the year, and they moved higher again in April. And I've talked in the past. There was I think it was 40 different economists did a really detailed research report and said, when the Fed keeps rates higher and they raise rates, rents actually go up because cap cost or any number of reasons why it happens. But the thing is, if rents keep going up and if wages keep going up, and if rents and housing is a big component of the core CPI and the core PCE, like it's sticky now. It's a problem. And maybe they have to go to 6% to bring it down. I have no idea. But that's the relationship, Jay, that I look at there.
And the dynamic right now, which seems to be the scenario, is that because rates are higher, uh, mortgages are less desirable right now, so people aren't buying houses and they're renting, and so they're actually hurting the rental supply. And right, housing costs are, there is a supply problem with housing. So guess what happens? Housing costs goes up in those scenarios. So it's almost like it's weird where you'd think, not weird, the initial impact of slowing down the housing market happened when they raised rates, but rates went up so fast now it's almost like it builds on top of each other that that component of the core CPI will continue to go up because rates are going up. It's a little bit of a it's an unfortunate symptom of rates moving this rapidly. I'm not sure that's something that people put a lot of thought into ahead of time when their only tool is raising rates and they just said do more and do a lot. I think it's actually going to start to keep CPI higher accidentally. I mean, it's kind of a weird, perverse relationship that's going on there.
It is, and I'll go another level, not too deep, but I'll go another level. Maybe I'll do a deep dive on this at some point. Is renting there's all these scenarios and formulas about is it better to rent or buy? And renting right now in all but like three major metropolitan areas is a better deal, and that's because mortgage rates went up. But I'm going to give you an interesting point. Let's say you finance $500,000 and the interest rate was 3%. The very first payment that you make, excluding taxes or any others, is just your interest and principal, is a total payment of $2,108.02. Okay, that's not important. What's important is the interest that you pay on that is only $1,250. The principal is $858. If I raise mortgages, the interest rate to 7%, my first payment is now $3,326. Again, it's higher. That's not shocking. That's not the news. But now the interest payment on that is $2,916 a month versus only $409 in principal. And so the reason I bring this up is most people want to buy because they think I'm paying money to somebody else or I'm throwing money away. But when interest rates get much higher on a mortgage, the amount that goes to principal is much, much less. And so this is where it's like, well, I'm renting or I'm paying the interest. And it becomes less about building that equity. I mean, when rates were 3%, you're almost 50-50 on your very first payment. So I bring that up, Jay, and it's just an interesting dynamic. It's more involved than I think we'll get into here. But the choice is not as clear as it once was, Jay.
I feel like that warranted the professor soundbite, because that was good. That was very educational, and it's actually pretty insightful, and nobody's talking about it, Derek. So
Nobody is talking about
those
that.
dynamics, no, no, it's just another one of those things that are kind of happening under the surface that the way, and I think you simplified it, but it's still too complicated for Bloomberg or CNBC to talk about, so we won't hear about it that way. So they got to get it from the Broken Pie Chart podcast.
Only here. All right, Jay. Last, we got to talk about the markets, and I think the market it's sideways. It's not that wide. We've seen it be in this range for a long time. We really haven't seen, but for a few days this week when the market was down over 1%, we haven't seen a lot of really big percentage moves. And this is from, who is this from? I found this on Twitter. Carson Investment Research and FactSet. So they came out with this thing. Stocks up big as of day 100 could mean more green. That was the title of it. And the deal is the S&P 500 year to date was up greater than 7% on day 100. And I believe that's trading days, as you point out. What happens the rest of the year? Jay, the average is, let's see, when you're up greater than 7% after 100 trading days, the rest of the year average is a gain of 9.4%. So a few years that it
On the
was
next 150 days,
the
that's what they're
next
saying, right? So
150. Yeah.
the next 150 average over 9. Got it.
So
That's exciting.
it it does. And, I think we're seeing some investment banks raise their targets right now. But I mean, who knows what's going to happen in the market? But I don't know, Jay. I mean, does good markets breed more good markets? Is that kind of the thing here?
Well, sure. Markets generally go up. We talk about that, right? And it's why we don't try to time entries, right? It's why we stay invested. It's why we stay hedged. We don't want to miss out on it, despite what everybody was saying. Nobody thought this year would be what a we're talking like a plus 18, right? If we get another 9 after, or we're up 7. I'm not sure when this chart was put together. I don't know when the actual 100th trading day of the year was. Seems to be about now. But right, if you add another 9, we're talking what? Somewhere between 16 to 18% for the year. I don't think that was in anybody's forecast, with the exception of one ultra bull on our IC, on our investment committee. But besides that, yeah, like I think that would be a nice surprise. And you're right. Usually the markets will, um, confidence breeds more confidence. And the more you could shake off fear, the more people realize, like, oh, I got to put money to work. And there were a lot of other choices for people to put money to work this year, certainly with treasuries paying, at the beginning of the year, close to 5, shorter term stuff, right? You want to, or even 4, lock that in, and you go, woo, I'll take that and avoid the market volatility. But yet on day 100, being up 7, 8, 9%, now maybe that starts to be a little interesting. And I think, Derek, you're right. This week, despite the potential Fed raising rates, and we all know the adage, don't fight the Fed, we still saw market flow into equities. We saw equities go up. And on those same days, we saw bonds go down, which tells me there is a risk on trade going, right? The rotation out of bonds and into equities was happening on a few days this week. And I think we'll start to see more of those stocks up, bonds down days, as opposed to the way it's been, more recently, which was bonds down, stocks down, right? Bonds were down because yields were going up and there was fear of the Fed, and stocks would go down, right? So I think we might be moving away from the stocks down, bonds down to, stocks up, bonds down type relationship. And there are times where, and it goes in waves, when those two have that inverse versus correlated relationship. And it feels like it's starting to switch over. And that's partially because the market is giving people the confidence to take more risk in equities.
People are rotating out of their blockchain and Bitcoin plays into the market. I'm kidding. I have
And
no
we're
research on that. I don't know. I mean,
Look, and AI may be the lifesaver, the party on the yacht, like you said, right? That's the thing. You don't know.
well, that's yeah. I won't get into that because we want to get to some recommendations. But
Let me just comment though one last thing on this chart, right? So in this little chart that you show here, so since 1950, it looks like, in all the times when the market's up more than 7% for the first 100 days, only once was the market down more than, say, 1%, and that was in 1987. And actually, in that scenario, it was down 14%. All the other times here, the market is up over the next 150 days. Some are smaller amounts than others, but that average of 9.4% is fairly accurate as the median. Like the median is 10% on that list of data points. A lot of these data points are double digits. A lot of them are 5, 7, 8%. There's a handful of 20s in there, but like two of them, I think. But my point is, it's a fairly steady set of data points, Derek, with the exception of 1987. I think we all know what happened in October of 1987. Those are pretty bad time to be in the market. I don't have the. A lot of people say they started in the business on that day. I did not, but a lot of people talk about Black Monday. And so, look, you've got that one data point in there that skewed the rest of the year, but the rest of it all is fairly bullish there, Derek.
yeah, and I think it just speaks to, you made the point. If we wanted to take this data and run it further, we'd say let's go against what the general market does. Like you always make the point, markets go up more than they go down. And the last time we saw two down years in a row was what, 2000, 2001, I think? 2001, 2002. That was 3 years, which is very odd. So markets generally don't go down 2 years in a row. We had a down year last year. And remember, a couple shows, I don't know how many shows ago, we talked about this. Michael Cantro's idea of the hope. It's housing, orders, profits, and employment. Well, housing, yes. Orders are down, although services are still going nuts, right? It's the goods. Uh, we've seen profits year over year. They've declined, and they're expected to decline the next 2 quarters. So we still could get employment, but I don't know. Like I keep getting asked the question, are we going to have a recession or not? And I like your answer. Like, who cares? It all goes back to earnings. The market front runs everything. And I'll let you know when it happens. But every recession doesn't have to be a 2008 recession. And markets go
Thank
up more often than
goodness.
not. I know. I mean,
That
it's rare.
was a
So
brutal one.
it
Yeah.
was. All right. So let's get can we just jointly make the recommendation? If you haven't watched Succession, you need to start immediately because the series finale is Sunday, Jay.
Yeah, and I know. And look, sometimes there's some episodes you got to kind of push through, but they're all good setups and they're all deep. There was an episode, Derek. We didn't even you and I haven't even talked about the election night episode. It was really kind of complicated. I had to watch it twice, and it was really well done. First time through, it was very technical to follow what was going along, but it just kind of showed what a news organization how a news organization can even impact on election night, what happens. I just thought it was very cool. It's a great show. You should watch. You should watch Succession and push through it. If you think it's boring, it's not. You just didn't catch all the nuances. It's good.
I don't know if we should predict who wins or who winds up running it. I
That's
have a
a
dark
lose
horse.
lose for us.
I have a dark
You
horse.
do.
I,
Yeah.
yeah, like I'll just give something away. So like for 5 seconds, plug your ears. But then because I have a really good recommendation as well.
All right. I'm not listening.
The well, you can listen because you've watched all the shows. Greg,
Oh, okay. All right.
because I think Matson is like, yeah, we're gonna do the U.S. CEO, but he doesn't say it's Schiff, and he's getting along with Greg. I think it would be hilarious for him to, or nobody wins, and that's the message. Like all the kids lose, and everybody's miserable. And anyway, so do you have a recommendation, Jay?
I think everybody knows the kids are dysfunctional. Yeah, the kids are dysfunctional. None of them can win. Just
Yeah.
has to be that way.
Do you
They
got
all have to
anything?
get
And
disappointed.
I'll give. I actually have a movie theater movie, Jay. But go ahead if you
No,
have.
no, go ahead. Go ahead. Go ahead with yours.
I'm going to give you the Covenant. So The Covenant in theaters right now. It's Jake Gyllenhaal is the lead on there, and it's about they're in Afghanistan. They use translators, and the story is he winds up leaving Afghanistan, but he's got to go back and somehow get the translator out. So without being political, there's a lot of our exit there was interesting, and but this was during the conflict, and it was really good. I thought it's in the movies now. I'm not sure if it's streaming yet, but so
The
yeah,
Covenant. Okay.
The Covenant. Yeah, you got
All
anything,
right.
Jay?
I will. Uh, I don't. I unfortunately, sorry, Derek. No additional recommendations on what I've recommended in the past, and of course, always Succession.
All right, and Florida Panthers hockey. You know it, you love it. They're going to the Stanley Cup Finals.
You know, it's my favorite team, right?
You need to go to a game. They're in your backyard. I mean, they're in Sunrise. How far away is Sunrise? Like an hour without
You know,
traffic?
40 minutes. Yeah,
Yeah,
40
yeah, yeah.
minutes.
All
Get
right.
out 45 minutes. Yeah.
Yep. So, look, I mean, Arizona, we have the Coyotes who may or may not be here because they can't get a new arena, but that's for somebody else to decide. All right, Jay, we'll be back and we'll tell you everything that we got right and wrong in the next week. Next week. All right, Jay. Are you here next week? Are you back on the show next week? I can't.
No, you're gonna have to go without me. And I think I'm not sure if Mike's around. Mike may be around, or maybe we get you another stand-in. I know that it'll be hard to compete with the brilliance of my sharing of knowledge here.
For
But
sure, for sure.
I think you need to share, and you'll need to get a stand-in if you want someone else to banter with.
All right. Well, everyone, we'll figure that out, and Jay will be on in a few weeks. So, Jay, thanks again for coming on. We'll talk to you soon.
Thanks, Derek.
Yep. See you, everyone.